Hello again, committee. We are back here at around 11:15. I know that you all just watched the emergency board meeting with Tom Cavett, and glad that you have been able to join us today, Tom. Would love if you want to do a brief overview, you're welcome to, or we can just dive right into questions.
If you guys watched the e-board, and thank you for doing so, then I think we can just dive right into questions. I think we covered, sometimes the e-board is a little more perfunctory and everybody's heard it a couple times already, and so it just breezes through. This one was longer. There were more questions and more commentary, so I think we covered most of the things that were important items. So glad that you all could watch, and I won't have to repeat everything. But yeah, let's just throw it open to Q&A and go from there.
Yeah, Representative.
Yes.
Well, I didn't think we were doing as well in our economy as you seem to be. But just my blindness, or what did you see that maybe the average person didn't see?
So this is something that I talk about in the report because economists have gotten flack, a lot of flack, for saying how good the economy is when, you know, a lot of people don't feel that it isn't, and has not objectively been good for everybody. But whenever you look at an aggregate statistic, it's comprised of millions and millions of, you know, conditions. And for any number that you have, there are winners and there are losers. So if I say, okay, GDP growth overall, that's the broadest measure, how the economy is doing, the US economy is tracking above real GDP growth, tracking above 3%. That's extraordinary. We haven't had that for a long time. That's the target that the incoming Secretary of Commerce is, this 3-3-3 plan you've probably heard of. Yes. So one of the threes is to get real GDP growth above 3%. That is really hard to do, but that's what he's targeting. And so it doesn't mean that everybody in the economy somehow is, you know, you could be working for a company that's going out of business and losing your job. And, you know, take a metric like, you know, people's net worth, you know, had been rising. Even if you looked at the bottom 50% of the net worth distribution of wealth, particularly around the pandemic, there were pretty significant increases in the net worth of the bottom 50% of the population. But it doesn't mean every single person had that. But I use the example of the stock market as one way to look at it. The stock market's way up, went up 26.7% last year. That's affecting our personal income revenue. It's affecting corporate revenue. It's affecting sales and use. It's affecting, you know, so there's more spending when people feel like they have more wealth. And a lot of the spending that's done is from people in higher income classes, not the very top, but, you know, upper middle class and above. It's a great deal, you know, more than half of the spending is probably 15% or so of the population. So it matters.
Like maybe 3 different charts in here about sort of the divide, the growing divide in the economy, though, which I think might be sort of the felt experience that you're speaking to a little bit, Carolyn.
Yeah.
And I wonder if you could point out those charts just so we can all see them. And then also the increase in credit liability is something that you flagged I think this summer, that I think is important to.
Yeah. So, but I'm just saying, so just to segue into that, Emily, when you look at equity markets and mutual funds, the Federal Reserve has a detailed database that breaks out assets and liabilities by various wealth classes, so percentiles of net worth. And if you look at the bottom 50%, they own exactly, as of the third quarter of 2024, 1% of all corporate equities and mutual funds. So that's, when the stock market goes up, nobody there is setting off fireworks, and that's half the population. So, is it bad that the stock market's, going? No, that's still a positive economic metric. And same with GDP. That's a metric of, the broad over group. Inflation has been a serious problem and a serious issue. And there are winners and losers in inflationary environments too. So aggregate wages have gone up more than aggregate inflation, just by a little bit. But within that, if you are a unionized worker, your wages probably went up quite a bit more than costs. And if you're not, you may have lagged pretty far behind. And so your experience is going to be different depending on how much power you have in the workplace. And that's what shakes out with every big economic change. There are players that have a lot of power and they try to make that work to their advantage. And there are players that don't. And that therein you get winners and losers. So a company who can pass along price increases, they will do so. And they'll end up with higher profits and higher profit margins. Some companies can't. So even though they may be powerful, they're losers in that equation. And maybe they find other ways to deal with it. But typically, if you have a lot of power, you have a lot more options in figuring out how to make things work to your advantage.
Food companies, milk, cheese, so Cabot and Single, 12 and Creamery, they would be losers then.
Well, it depends how it's played. Sometimes you're caught in the middle. If you're a producer, if you're a distributor, or if you're, so there are different dynamics. To the extent that you dominate a market, you can usually pass prices along. If it's a competitive market, it's hard to be in an inflationary environment because it's hard to pass costs on. And then you really need to be the most efficient producer. And you can win because then you don't have to raise prices as much and people buy more of your product and you may run somebody else's business.
Representative Wazza?
I think it ties back to what Emily was speaking of, Representative Kornheiser was speaking about earlier. On page 33, you have the chart of the household wealth of the top 0.1% versus the bottom 50% through Q3 of 2024. And it looks like there was a significant increase for the bottom 50% from 2011 to 2022 or 2023-ish. And then it starts to decrease again. So, just an observation that I think when we talk about a good economy, what we're really talking about a lot of the time is the rich getting richer and increasing the aggregate size of the economy. But I'm curious if there's much information on Vermont specifically about the trend that we're seeing on this chart with the top 1% increasing and the bottom 50% decreasing in household net value. Is that true in Vermont as well?
Okay, so there are not credible wealth statistics at the state level, anywhere near where the level of detail or credibility as the national data.
So there is a great report that Joyce Manchester drafted this summer that I recommend looking at.
She tried to segue from one to the other, but you're making a lot of assumptions that could be pretty heroic. And the reason is that in a small state, given that there are very few players at the really high end, and the top 1/10 of 1% is nationally 132,000 households. So when you get down to a little bitty state, there could be a handful. And depending on who that handful is, it could dramatically change the numbers. We see this sometimes with very lumpy tax returns, where all of a sudden somebody will pay $10 or $15 million or even more. And it's a single event. It's an unusual sort of thing. But when asset prices are elevated and normal transactions occur, and if you're in the top 1/10 of 1%, then those are normal kinds of gains and the like. It's just hard to know without actually identifying it. And the Federal Reserve Survey has a very high sample percentage of the very top. And they have access to data that we don't have at a state level. It was just what's on a tax return that we can look at, but that's income, not wealth.
So I just, a more meta thing is, I guess I would think that over time, the legislature should work to get some more of that granular data on the Vermont level, because I would like to know how that trend that we're seeing nationally is impacting whether we say or not we have a good economy, because I just feel like for my constituents in Barrie, it does not feel like we have a good economy right now. And I understand it's experience versus the data, but
Yeah, well, there are a couple things happening too with that. Is one, sort of it's compared to what? And then also there is increasing kind of partisan takes on that. You see this in the consumer expenditure and consumer confidence measures. So they'll ask people, what their opinion is of the economy. And there's a split between parties that didn't exist before. I mean, it existed to some degree, but it's about double what it did
I read
before.
this somewhere, yeah.
Yeah, so there's a chart from the last forecast thing, I think, on that shows, when one administration comes in, how do you think about the economy? Oh, it's great. Well, you're listening to some news source that's telling you it's not good. And then you're nodding and internalize that and then say that. So, I mean, I'm just looking at numbers, and I'm looking at numbers that affect tax revenues. So if there's a number like net worth or personal consumption expenditures or retail sales or things like that affect tax revenue, and I understand that linkage through mathematical models that we have, I don't care if somebody doesn't feel good about what the spending is, it's impacting tax revenues in a positive way. That to me is, that's a plus. If you go back far enough, you also see these long cycles. I mean, when you look at the net worth numbers on that chart on page 33 you have, and you see it dipping around 2009, 10. Now there was a steady, if these data went back before 1989, you would see, and there were periodic surveys that were done, you would see that the net worth of the bottom actually declined more in the starting in the early 80s. So there were tax changes and things like that affected it, but that's sort of the start of, generally speaking, a broader decline in and more inequality in both wealth and income. But you look at what the recession did, and that's what the big dip is about. So it's sort of trending down a little bit, but then that recession hits, and believe me, anybody now in this economy, if they experience that, they would say, all right, maybe I think I should be getting more money from the job, or I don't like the hours that I have to work for the job or whatever, but at least I have a job. And back then you didn't. So it is kind of a relative thing. And the pandemic, because of the transfer payments that were made, early on, it disproportionately helped the bottom. There's that little bump that's there. That's the pandemic. It didn't last very long, and people used it to pay down credit card debt in large part, because this group, bottom, has the lion's share of, or highly disproportionate shares of credit. So more than half of the consumer credit, about 51%, is held by the bottom, 50%. And I think it's about 26% of the mortgage debt, even though they own 10% of the real estate. It's
Yeah.
to the extent you own a primary residence.
Yeah.
But a lot of that is not equity. It's still positive. So there's still have equity in real estate. But when you look at the consumer debt and you look at consumer durable assets, the consumer debt's more. Now, that's not only buying consumer durables, but a lot of consumer durables are bought with debt. So that's, washing machines and vehicles and things like that. So debt is, the liability side of the ledger is big for the bottom 50% in a way that is not for the rest of the wealth percentiles. I mean, it just goes up as you would expect.
And Tom, what I partially hear you saying, and what Jeff somewhat made a joke about in the e-board meeting, is that it's not your job to say whether or not that sort of increase in income for even lower income folks is commensurate with their need to spend on, say, healthcare, housing, or anything like that. That's not what you're modeling. You're modeling about how much revenue is coming in, right? And
So-
like how much is being, raised in each person's pocket or wallet, but not necessarily where that.
Yeah, so disposable income would be the metric for something like sales and use that you're
Yeah.
looking at. But your income, so personal income is taxable income is what we're trying to get to when we're looking at
Yeah.
flows of personal income. And we get a pretty high percentage of that from the upper end. So that does affect the state because anything you vote on to spend money on, a lot of that money is coming from higher end taxpayers that are paying personal income tax and corporate and estate tax and things like that.
Speaking of higher end taxpayers, I wonder if you could spend a minute on the property transfer tax projections.
Which feature?
17,
And every time there's,
last bullet point.
yeah, so every time there's a new tax, it takes a while when it's implemented to really understand, what it's going to be. And there are surprises on the high side and there's surprises on the low side. And there have been hundreds of taxes that we've analyzed, over the last 25 years that some are right on, some are easy. You just change the rate a little bit and there's a little bit of elasticity, but you pretty much know what you're going to get depending on how it's collected and who's paying. Sometimes there's really good compliance, sometimes there isn't. Something that's kind of brand new, a new area of taxation is, there are questions about it and requires somebody doing something differently. The cloud tax, we can't separate that, but it looks from the data like that is just not yielding to date the kind of money that we thought it should. And we looked at other states and things like that, but that's a laggard. But we're only 6 months into the fiscal year, so it's too early to really know. But we did sort of adjust with a phasing in. Property transfer, that will be something we can call out at some point and look at, but we're getting more from that than we expected. But that's strictly based on volume of transactions. And I'm surprised at the number of transactions and it needs, we need to look at, given the interest rate environment that we're in. So, we're not seeing, a lot of.
We're getting a lot more caveats than are in this paragraph. I'm like fascinated. This is, you're adding a lot more caveats verbally than are in the paragraph, and usually it's the reverse. of
Okay.
that. So it's really interesting.
Okay, yeah, I mean, all of these things, we drill into until we run out of time, basically. And we're really literally putting in 15+ hour days between, the start of the year and the time we have to produce tables. But there are things that you discover that don't align, and then you try to figure out why. I'm not all the way to the bottom of the property transfer tax thing. So there was also a formula thing that was an error in the first half for the target tracking, and that's been corrected. So that explains a little bit of the boost. But it looks like there's more activity in property transactions than we would have guessed, given the interest rates that are still quite high.
And so I see a 42% increase from FY '24.
That is
Are
mostly
you-
the tax, but
Yeah, are you imagining? Are you modeling any elasticity related to the increase in taxes when you look at property transfers?
well, we were originally,
And that doesn't seem to be bearing out.
well, it's too early to know, but I think there otherwise would have been a decline. All
Okay.
right, so again, with the economic environment that's affecting property transfers, we would have expected a decline. So that entire increase is new money from the tax. But maybe we're wrong. Maybe the base actually, it weathered those with private financing or with some other reason for that. I actually can't think of a reason for accelerated property purchases the same way I can like for motor vehicle purchase and use, where people expect with tariffs, the price of the cars might go up, that there'd be any impetus to be trading land, buying property or something.
All the new people that I've met through to talk about politics, it was campaign season. So like talk to a lot more people than I do and talk to people all over the state. All the folks I met who moved to Vermont moved here for like social reasons, like sort of the continued political national divide, and sold their houses somewhere else for more money than, so can buy their house with cash here, right? Because they sold it for more than the house was worth.
Yeah, so I mean, as much as our
It was
housing
like
prices
social
risen,
urgency and then cash.
yeah. Yeah, I mean, you will look at some of the charts on housing prices if you want, but they've been astronomical in Vermont. And so people complain about housing prices, but relative to Massachusetts and New York and other states, they can still sell what they have, come in and buy a lot more the same price. So particularly though, if they're not having to take a mortgage. Problem that's been freezing up housing is people that own houses now with mortgages don't want to get out of the mortgages they're in. So they're sort of locked in. So great, I'm getting a really good price on my house, well, but I'm still got to buy another one. And if I'm having to borrow to do that, I'm paying a whole lot more in interest. 30-year mortgage rates are still like around 7, even though there's been 100 basis point cut in the federal funds rate. So,
Representative Holcomb?
yeah.
I think I may know the answer to this question, but I'm going to ask it anyway. In terms of the properties that are being transferred, do you have any granular data on the value, how many people are represented or driving that 42% and geographical density of where it is?
So most of it would be the change in value, not the volume change. So again, if you're increasing a tax,
And then
You're not
are
having a
these
big vote.
high-end homes or all homes? Is it distributed across the distribution of homes?
yeah, the short answer is I don't know. So there are data though that we could look at that would break that apart further because we have very granular data on transactions. But it's not as easy to compile as some of the tax data, but we can do that. So that's definitely something we'll be looking into.
And the new
Typically,
tax is just for higher end homes, basically.
but that would suggest that that's where there's action.
Which is why you might want to map it.
Yeah, absolutely.
Yeah, definitely. See, when we have a plethora of new taxes, there's only so much time to get, all the way down in the weeds on something. And that's one that we could go further with because there are data. So those are good questions and things we'll keep in mind because by the time we do the July one, the next forecast, I would expect to have a lot more clarity on what's happening, exactly where that one's coming from, and probably a better forecast of what's going to happen. We spent a lot of time with real estate forecasting in general, not just for the state, but for other purposes, financial institutions, things like that. It's, really the big nationwide run up in housing prices during and after the pandemic is a colossal risk to the economy in some ways because there is a lot of downside to it. So same way with the stock market. If house prices go up way more than income does, at some point, you have to, the people that are buying houses have to be able to afford them. And so the people that need to sell will cut price in order to sell if they have to sell. And that hasn't really happened yet. I mean, we're still getting like 9% year over year home price growth. And New England lags the rest of the country. This is not unusual. Right now, the highest home price growth in the country is occurring in New England states, and there are a handful of other states scattered in, but, you know, New Hampshire, even Connecticut, which had really lagged for a long time, it's benefiting from remote work. Connecticut is. Even partial remote work has been a benefit to Connecticut and home prices there. But it's, yeah, anyway, interesting question.
I mean, I guess, and I think the town data is often we realize too late when things are changing. And, you know, this is just my wonder, I don't know. But I mean, we come from an area where housing prices are more than double what they were just a couple of years ago. And what people are saying when they move in is that it's not about need anymore. It's about people using it as an asset. It's a financial asset.
Uh-huh.
I literally have had people say that it is a safer investment in our community in a home than it is in the stock market. And so I worry about the bubbles and I worry about the behavior and the unintended behavioral consequences. And whether or not in that data, we can get some insight into what's going on that might help us understand broader patterns. When I have someone tell
Yeah.
me that they moved
Yeah.
and they took their $90,000 in income tax revenue to New Hampshire, and their home is now a second home, which pays a 40% lower tax rate. Is that an anomaly? A one-off? I don't know. But it'd be worth knowing before we end up cannibalizing our revenue base.
Uh-huh. Yep. Those are a lot of good questions. And there are data that can address some of them, but not all of those things. But there are proxies that could probably lead you, you know, shed some light on it.
Mhm.
So maybe we should make a list of those questions and
Thank you.
send them to me, and I'll see which ones are the next round in July we could dig deeper into. Yeah.
Just two questions. Just one is on the data, I agree with Representative Holcomb that I know there was a huge rush to close on second home purchases before the new tax went into effect.
Right.
It'd be great to see what the monthly is for the last half of the year at some point in time.
Yeah.
The second question is on your projection for childcare revenues coming from the childcare payroll tax, $5 million below. I'm just wondering if that's normal of any other programs you can point to where there's a lag and then general compliance catches up. I know that you want to stick with a forecast for the revenue in that, but can you point to another one that had that similar lag until compliance all came into place?
Not of that magnitude. And the estimate's 5 million ahead above what's been actually pulled in. Yeah. So what we're carrying on the book, and there's a whole paragraph on that.
Yeah.
But what we're carrying, you know, on the general fund revenue subtracts that theoretical amount. So if it's off, the fact that personal income withholding, which is where it comes from, has been at or above target, means by the end of the year, you know, there will be money that's not accounted for anywhere that, you know, is the theoretical amount that should have gone into the childcare tax. The fact that it didn't will be a political decision as to whether you move those surplus funds into that or use it for something else. But we just thought it's such a confused, I mean, the amount of time we've spent with tax trying to get to the bottom of, you know, where the problem is. And so they think, you know,
Administrative perspective.
it's not just administrative compliance. They're doing a good job tracking the stuff that comes and reporting it. That's great. And
I think I consider compliance part of administration.
okay, yeah, okay, fair enough, because they do the
That's-
follow-up on the thing. But their awareness of the tax, they thought they had done a lot of, you know, distribution, informational sort of stuff. And they're doing more of it now because I think they were surprised as well. You you know, that there wasn't more coming from it.
Because you said actual collections did have been much lower than expected.
Yeah, yeah. So again, it's very lagged, but the first quarter, there should have been a liability due at the end of October. And then we get money that's actually come in where people check the boxes for the childcare tax. And it's, you know, 18 million instead of 23 million.
We only have one quarter so far.
There's only one completed quarter. So January will be another one, but, you know, we won't know if somebody's paying in January, they might make a payment to catch up for the first quarter because they weren't aware of it.
Right.
And what I think is, you know, you'll get tax professionals coming in at the end of the year. So to close the books, and a lot of companies are on a calendar year basis, and they'll figure it out because, you know, it'll be in the software and that kind of stuff. So they'll know. And then they'll say, oh, you didn't pay that. So, you know, we're going to retroactively make that payment. So there'll be truing up that occurs. So I think a lot of it will happen in January, February, March. And a lot of corporate returns, you know, deadlines are in March. So, you know, there'll be money coming, but we won't know what quarter that's for. So they'll make a payment. That's great. Maybe then January is going to look high. I bet it takes longer than that to catch up. And then you have the whole April filing thing where individuals, self-employed, are supposed to do it. And so we'll see what happens with that one. There may be catch up with that too. But anyway, all that's in the mix. And the way the lags work, we're not going to have really good data by the end of the fiscal year. So that's why in the e-board meeting, Jeff said it will probably spill over into the next fiscal year before we really have a handle on it. So anyway, it's been tricky. I'd say this is a messier issue than we normally, or I don't know if I'd say ever, but normally have with a new tax.
Representative Messel?
Yeah, follow on Representative Holcomb's comments on people buying Norwich properties.
Except for two.
They,
I know you like to pick on Norwich. This is
well,
two.
in Deptford
I was
properties,
actually talking about
this is the.
One of them lives in Norwich and the other one lives in Dayton.
No, because when I researched it,
On the comment on people, families, whatever, buying properties, real estate properties, you know, residential, as asset purchase.
yeah,
It may not, the information I'm looking at may not be something you normally track. But for example, for the towns in question, some people have chosen to move there because of the school system. It doesn't necessarily increase the number of students in schools because families are small. But the behavioral influence of, I have children, where am I gonna move? Where am I gonna purchase my house? I suspect very much plays into the questions of where people are moving and why. And it's difficult to parse it out because the school system population seems to be relatively constant. Maybe it's creeping up. You don't figure that out right away. You don't know people's motivations necessarily yet.
yeah, and you know, there are data that show that the quality of schools affects the value of properties. So
Yeah.
if you were doing a hedonic model of property valuation, that would show up as one thing that's a significant thing. You know, when you look at like all the things about a house that could affect it, does it have a view and how many bathrooms and quality and all that kind of thing. But that's one that's normally is not insignificant.
And thank you. And some of these towns are doing a townwide reappraisal and it affects people's perceptions of, do I want to go there or not? Look at the taxes kind of stuff. And it then doesn't shake out for a year or so when assessed value plays into tax rate in the town. I know you get this stuff. I'm just bringing these up because it, as you point out frequently, Tom, a lot of these factors interplay with each other in a way. There is a definite lag, particularly for us around the table, rather in your shoes.
Yeah,
Thank you very much.
yeah.
It's helpful.
Well, as an investment, you know, it would not be a particularly great time, just as a pure investment play, to buy into residential real estate. It's just gone up so much because it's like the stock market right now, you know, how much more room is there above this? And, you know, and you pay property taxes on it. So you've got a drain. And I think, you know, there were a lot of people thinking of it as an investment that were then thinking, I'll rent this as an Airbnb or so. So I'll cover all my costs by doing something like short-term rental. Then I'm investing in it. So any appreciation I'm getting is pure growth because I'm covering my, you know, ongoing expenses with short-term rentals. And so that was a non-trivial part of the market. But that at some point will get saturated because there are only so many visitors and you're having to cover your property tax costs. But it flips sort of a property that's nominally residential into one that's essentially a hotel, a non-residential type building. And I'm using non-residential in the way the Commerce Department talks about types of buildings, not the way we say the second home is non-residential. Anyway, it has a use that is different. And at some point, if you can't rent it and cover your costs, then you're going to want to bail or you'll have to bail. And those are the properties that start to be, they're sold sort of with more of a fire sale kind of thing. You know, they have to be sold. And that's when you start to see price drop and then that can steamroll. Anyway.
As much as I would genuinely love to talk about this for like another 6 hours, we have to wrap now. And
Okay.
thank you so much for your time
Hey.
and the multiple presentations. And I hope you enjoy all of your other committee visits today.
Well, I like the Q&A, so thanks for that. And if there are other ones that are follow-up, feel free to send me notes and stuff like that. Yeah.
And if folks do want to send questions to Tom, please send them through Sorsha and then we can manage that. Thank you.